Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Let's take on a bit of Wall Street terminology. Market cap, or market capitalization, is the value of a public company. This value is calculated by multiplying the share price by the number of shares outstanding. A related term is the PE, or price to earnings ratio. This ratio can apply to an entire market or to a single stock, and is the price of buying a future stream of expected earnings. Generally speaking, a high ratio indicates the company is expected to grow its earnings and cash flow at an above-average pace. The share price of a given stock can rise either because earnings rise or because the PE ratio itself rises. Because of this, the PE ratio is of exceptional interest to investors. Let's cover a few factors that might make this ratio higher or lower than average. Low interest rates can cause a high PE in two ways. First, investors who are discouraged from buying debt by low returns will instead pursue stocks and add to the demand for them. And remember, all prices are set by the balance of supply and demand. Second, low interest rates make future earnings more valuable by lowering the discount investors require to wait for these future earnings. When interest rates are low, the cost of waiting for future earnings is reduced. It's important to never underestimate the impact of investor sentiment on the PE ratio. Markets go in and out of fashion and can get extremely happy, like in the year 2000, and very unhappy, as in 2009. Optimism about the economy and favorable political developments can also create a higher PE for overall markets. Next, a dividend is a quarterly distribution of cash to investors. These often reduce the volatility of the stock price, as dividends are rarely lowered and thus represent a more predictable part of the investment return. Most dividend-paying companies are in mature, slow-growing markets and often have very steady income. Utilities are a classic example. Dividend-paying stocks can be very helpful to retirees as a source of cash flow. Well, that's it for this session. Thanks for watching, and I'll see you next time.